Hello, my name is A.C. Clinton, and I am the Marketing Director and Senior Loan Consultant for your home loan partners of Pan American Mortgage, LLC. And I like to begin each of these video series by simply saying thank you. Thank you for considering us to be your home loan partners throughout your home buying process. Today, we're going to be talking about equity building in any market. So let's go ahead and jump right on in. First and foremost, what is equity, or what's the formula for building equity? Well, that formula is simple. It's simply the current market value of any real estate minus the current loan balance. So let's look at an example. Say you find this nice Chicago-style bungalow, and the current market value for the bungalow is $150,000. You have a loan balance of $125,000. Now, to determine the equity position for your Chicago-style bungalow, you want to subtract $150,000 minus $125,000, and it's going to give you an equity position of $25,000. Now, I know we hear a lot about the market being on a downward spiral. And it's important to note and understand that real estate market values in general are cyclical. There are times when it goes up, there are times when it goes down, there are times when it stabilizes. If we just look at what has occurred with market values over the last several years, we'll see starting at 1975 here that real estate has gone up and it has gone down. There have been times where it was stabilized. Well, as we can see here, up until about 2001, 2002, there was a stable, gradual increase. There were some little down dips throughout that period, but there was a stable, gradual increase in market values. And in 2001, 2002 is when we began to see this major spike in home values. And that's where we created the housing bubble, or terminology that we hear a lot of today. And as we can tell at the top of that bubble, which was about in 2007, that it began to stop and it began to spiral down. And that spiral down happened rather rapidly. Almost as quick as the increase, we see the decline. Well, if we look at 2009, it has somewhat stabled out, and there's been a little rise or increase in property values. Now, no one knows what's going to happen after this point, if it's going to continue to rise back up, or if it's going to stabilize, or if it's going to drop even further. But once again, the important thing to remember is that real estate is cyclical, and even in downturns, there will become a period of time when it will go back up. So, let's talk about the three different types of markets and how to build equity in each of those markets. The first market type is going to be a rising market. So how do you go about building equity in a rising market? Well, current homeowners are able to see considerable increases in their equity position in a rising market. The perfect example would be during the housing peak in 2007, some homeowners saw a surplus of $100,000 increase in their equity position. Now, first-time homebuyers can take advantage of equity building by purchasing below-market homes, rehabbing them and creating instant equity, or purchasing homes at market value, and because it's a rising market, they're able to build equity over a period of time quicker than they would in any other type of market. Once the equity has been built, homeowners have two choices of tapping into that equity, or two ways to tap into that equity. The first way is going to be a cash out refinance. Simply refinance the property, pull out some of the equity in the form of cash, or liquidate the property. So sell the property at market value and finance a new home, preferably a home that's below market value that you can rehab and create instant equity. Now, our wealth building key in a rising market is to reinvest extracted equity in investment vehicles that yield consistent returns over a period of time. Now, we go into greater detail of this particular concept in the capital gains exclusion video series. So check that out for more information on that. Now, let's go ahead and talk about the second type of market, which is going to be stable markets. How do you go about building equity in a stable market? Well, in stable markets, current homeowners can create equity by simply paying down their mortgage balance. Remember our formula. Equity position is created through current market value minus current loan balance. So therefore, in a stable market where the market value isn't increasing or decreasing, it's stable, the only way to build or create equity is by paying down the loan balance. First-time home buyers could take advantage of equity building by purchasing below market value homes, rehabbing them, and creating instant equity. Or purchasing a home at market value and build equity over time by paying down the mortgage balance. So our wealth building key in a stable market is going to be invest more funds to pay down the mortgage, maybe by making an additional mortgage payment per year. It's amazing how making an additional mortgage payment per year reduces the term of that loan. So if you have a 30-year loan and you make an additional payment each year, it can reduce the term of your loan by 6 to 8 years. Awesome. The next type of market is going to be a declining market. How do you go about building equity in a declining market? Well, for current homeowners, in a declining market, they should continue to pay down their loan balance and, if positioned to do so, consider upgrading. Over time, the market will stabilize because remember, once again, real estate is cyclical, and current homeowners will be able to rebuild their equity position as the market stabilizes. Upgrading to a bigger or better home, preferably a distressed property that can be rehabbed, and an opportunity is presented to create instant equity. What do you do with the home that you currently own? Well, consider renting that out as opposed to selling it unless you have a good offer on a sale. And another option would be investing in rental units, therefore creating additional income on a monthly basis, which we call cash flow. Now, cash flow is simply the difference between the monthly rent that's collected and the monthly expenses for that property. What's left over, surplus, is cash flow. For first-time home buyers, yes, you guessed it. Take advantage of equity building by purchasing below market homes, rehabbing them, and creating instant equity. Our wealth building key in a declining market is going to be create instant equity position by purchasing distressed properties and creating a monthly cash flow opportunity. Now, this can be done even with the first-time home buyer because you can buy a multi-unit building, live in one of the units, therefore your tenants are able to pay your mortgage in most instances, and there are opportunities you can still walk away with cash after your mortgage has been paid. Now, as you can see, equity can be built in any market type. Of importance is the strategy that you are using to invest in real estate, period. Well, that does it for today. We hope that information was helpful to you. And remember, should you have any questions or concerns, please do not hesitate to give us a call at 877-588-6956 or email us at loans@yourhomeloanpartners.com and visit our website at www.yourhomeloanpartners.com. Until next time, see ya.